Bloomberg Audio Studios. Podcasts, radio, news.
Let's turn back to the Federal Reserve. The president pushing for Fed Chair Jay Powell to go big.
The Fed chairman's incompetent. I think you have a big cut because I don't think he can help with cutting. It's perfect for cutting.
Traders betting with near certainty the Federal Reserve will cut interest rates by 25 basis points this week. Joining us to discuss, the former New York Fed President, Bill Dudley. Bill, welcome back, sir. Let's get straight to it. What are you expecting to see this coming Wednesday?
Right along with everybody else, I expect a quarter-point cut. It's baked in the cake. I'd be surprised if they do anything else.
Do you think they'll guide much beyond that?
Well, there'll be guidance because they're going to publish the summary of economic projections, which shows their interest rate outlook for the rest of the year and into 2026 and 2027. And I think the big debate there is, do they show one more cut after September, or do they show two more cuts? And I think it's going to be a very close call between those two outcomes.
Yeah, Bill, I think we should build on that. That's the interesting piece of information for me, that at the last meeting, the last round of forecasts, if you will, they were forecasting two cuts, and they had unemployment year-end at about 4.5%. And Bill, we could have this really strange situation where people are basically looking for the unemployment rate to stay steady in the forecast, but all the dots to come down. Bill, just what's happening there? What is actually driving the outlook for rate cuts? If it's not unemployment, what is it?
Well, I think you're right that the forecast is evolving pretty close to what they had the last summer of economic projections in June. So if they're on the same forecast track, why would they pencil in more rate cuts? I think the thing that's changed is just this weakness of the labor market in the sense of payroll employment growth. It's only been 30,000 a month over the last 3 months. And you see a lot of indicators that the labor market is continuing to soften. So I think it's more the softness of a lot of the labor market indicators that are getting them concerned that the labor market could continue to deteriorate. So I think that's the biggest risk right now. And so that's what's causing them to have a little bit greater urgency.
Bill, doesn't the market agree with them? Isn't that the takeaway from the rally that we've seen in the long end of the yield curve?
Yeah, absolutely. I mean, market is in agreement that rates are coming down, not just this year, but in 2026 and 2027. In fact, the market, if you look at the federal funds futures market, it has rates coming all the way down to about 3% on the federal funds rate by the end of next year. So there's a lot of rate cuts priced in. I think, personally, I think it's not quite so clear that they're going to go that far over the medium to longer term because the financial conditions are already very, very accommodative and the economy is not falling out of bed. I also think we haven't seen the full effects of the tariffs in terms of prices yet. So I think, inflation is going to stay sticky over the next 6 to 12 months.
So I want to dig a little bit deeper into what you just said, the idea that the long end of the yield curve is pricing in steeper cuts. You could make the argument that if the economy isn't falling out of bed, that any steeper cuts would cause a reacceleration in inflation and potentially some deterioration in the dollar that could cause kind of the opposite in the long end in terms of a sell-off and a yield curve steepening. What's your understanding of why the market doesn't seem concerned about that?
Well, I think they think that the reasons for cutting now are actually quite compelling, given that the inflation pass-through from tariffs has been smaller than expected, and the weakness in the labor market has been at least as large as expected. So I think the market shares the view of Jay Powell that the downside risk to the labor market outweigh the upside risk to the inflation. So therefore, rate cuts are warranted. But I think the question is, how far are they going to go over the medium to longer term? That's where the markets, I think, may be a little bit ahead of themselves. Now, some of this, it's hard to factor in how much is the pressure of the Trump administration on the Fed and, some risk that the Trump administration could compromise the independence of the Fed. Now, obviously, if the Trump administration is successful in doing that, that's going to be lower rates, but it's also going to be higher inflation.
Bill, just to talk about what we might get from the news conference as well with Chairman Powell, how difficult is it going to be for him to establish a consensus at this meeting? If you go back to the last dot plot, and things may have changed, but in the last dot plot, there were a big group of individuals that saw no cuts in 2025. And I'm just wondering how much has changed, not just for Chairman Powell, he's indicated a lot has changed based on the last few times we've heard from him, but for other members of the committee.
I think most people are going to go along with what Chair Powell wants because they're not in disagreement about the direction of rates. They're just maybe have a small disagreement about timing. Should we start in September or should we wait a little bit longer? So the fact that they're all in agreement that rates are going to be coming down, I think they're going to give the chairman what he wants at this meeting. So I'm actually expecting very few dissents on the side of no rate cuts, maybe 0 or 1. The other side of the equation is, are we going to get 50 people supporting a 50 basis point rate cut? And I think the only person I'm expecting there perhaps is Steve Moran, if he gets confirmed and is sitting on the FOMC on Wednesday afternoon.
Bill, do you think that it's healthy to have a character like Stephen Miron on the Federal Reserve, on the Board of Governors, to really foster a robust debate about not just whether to cut 25 or 50 basis points, but the overarching framework that the Fed is operating in?
I think it's good to have a diversity of views on the Federal Reserve to debate a lot of, the framework. I think the Fed could do quite a bit more in terms of developing a framework for quantitative easing and quantitative tightening, and I've written about that over the last few months. So I think there are things for the Fed to do. I think it's a little odd to have someone that's essentially on loan from the administration for 4 months to vote at 2 or 3 meetings. So I don't think that Steve Moran is going to get a lot of deference at the meeting this coming week.
Bill, for people who aren't familiar with the meeting, a meeting that you've been a part of many, many times, can you describe to them what that kind of room will look like, that situation, how the meeting actually progresses, who runs things, and what kind of opportunity Stephen Miron would have as he sits around that table to make his points?
So the meetings typically are obviously chaired by the chairman, and there's typically a discussion about the economy. Everybody goes around and gives their views on the economy, and then there's a discussion about monetary policy. Everybody goes around the room and talks about their views on monetary policy. So Steve Moran will have a chance to speak on both of those, but he's going to be only one of 19 people speaking. The idea that he would go there and dominate the meeting, I think his influence is going to be quite small.
Bill, do you take it in turns? Are there any kind of debates at all, or do you just go around one by one around 19 individuals?
No, there can be some back and forth. People do respond to what other people say. But I mean, remember, everybody's looking at the same set of information. So the disagreements tend to be small, more at the margin rather than large, because everybody's looking at the same set of information, hearing the same staff forecast, evaluating the same economic information.
Bill, appreciate your insight, your experience too. Bill Dudley, the former New York Fed president.